Hi, everyone. Welcome to the Market Talks series of Intelligent Investing. I'm April Tan, Chief Equity Strategist of COL Financial. The banking sector has been one of the best performing sectors for the year-to-date period. In fact, it has consistently performed well during the past few years, significantly outperforming the market because of banks' strong earnings growth. Did banks continue to deliver impressive earnings growth during the first quarter? To answer this question, we have the privilege of talking with COL's banking analyst Charmaine, who will share with us what happened to loan demand, net interest margins, and provisions, which impacted banks' net income during the first 3 months of the year. Thank you, Charmaine, for joining us in the show. But I just like to know, because earlier on I had mentioned in the intro how the banks had performed really very well since 2022. So how would you characterize the growth for the first quarter compared to what you saw in the past? Because that was one of the reasons why these banks have been performing well. It's their double-digit earnings growth.
The earnings growth in particular was more modest compared to what we've seen from them in the previous years. If I remember correctly, as a whole, the aggregate sector's net income grew by around 6.4% this quarter. And that's actually the slowest that we've seen it since, I think, 2022, like second quarter of 2022, where the banks did around 6.1% earnings growth. That being said, even if it was slower than we've seen previously, most of the banks except for Union Bank did report earnings growth.
So I guess one of the major drivers for earnings is loan growth. So during the first quarter, did we still see loan growth picking up and remaining strong? And what segments did they come from? I mean, did they come from across the board, like corporates and middle market and consumers, or you just saw it from one segment?
Yeah, for the loan growth of the banks in the first quarter, this did continue. Of course, I think it was lower sequentially, meaning from fourth quarter compared to first quarter. But that's to be expected since the loans are seasonally strong towards the end of the year. Going into the broad categories of loans, I would say the trend that we noticed in the past few years, which is consumer loans growing quicker than corporate loans, this is still true as of the first quarter. I think consumer loans were growing maybe mid to high teens, and then corporate loans were more in the high single digits, around 9% in this year. Yeah, in the first quarter.
Mm-hmm. I'm just curious if they went down during the first quarter because of the rate cuts. We had the BSP already cutting rates late last year. Or did the positive impact of lower RRR or reserve requirement ratio offset this? Or were there any mitigating factors that prevented a reduction in the net interest margins?
Yeah, of course. I think I would say that the NIMs this time round were maybe stable to actually slightly up year on year, which is maybe surprising if you're focusing on the impact of the BSP rate cuts. But then, as you mentioned, there were also a lot of other factors that mitigated this. The first of which was the lower reserve requirements. So the BSP first reduced it in October last year, right? And then they reduced it again this March. So for the first quarter, we would only have seen the impact of the October reduction in the RRR. So before, when boosted by this, because deposits that were previously not earning any interest income are now generating interest income, since they can be used to fund loans or to fund securities. Apart from this, I think I would mention two other mitigating factors that help NIM. So the first would be the shift in the loan mix. So as a whole, I think the sector is seeing much quicker consumer loan growth, and therefore the proportion of consumer loans has also increased relative to the size of the total portfolio. So given that the consumer loans have higher yields, typically compared to corporate loans, the shift in the loan mix more in favor of loans to consumers would mean, of course, that the average asset yield of the bank would increase. And then, yeah.
Yeah, I think you had also mentioned that for the consumer loans, what's popular right now would be your credit card loans and personal loans. And like, what kind of interest rates do they earn for the banks?
Yeah, for the banks, I think we would also be familiar with it since we have credit cards of our own, they charge like 3% every month, right?
Yeah.
So for a full year, 36.
36.
And personal loans could be even higher than that.
Which is why the margins still improve.
Yeah.
Yeah, but it will be interesting to see if they can maintain those kinds of margins.
Yeah, in the future.
In the future, okay. Yeah, and well, you know, I think another question that a lot of investors have right now is the performance of the big banks, the big three banks, BDO, BPI, and Metrobank versus the smaller banks. Did you see any difference during the first quarter?
I think that the main difference I saw was that the earnings from the big three banks were maybe more stable, or the earnings quality was better. And versus the smaller banks, actually across the smaller banks, there was more of a variation in their earnings. So some had really good earnings like PNB, others had asset quality challenges, and some declining ROE. So it's a bit more different within the smaller banks, whereas among BDO, BPI, Metrobank, solid ROE, stable asset quality or improving asset quality, and still earnings growth continuing.
What about loan loss provisions? Did you see them going up during the first quarter, or did they go down? And, you know, like maybe you can comment on that.
So for the loan loss provisions, I think this actually increased a significant amount. Of course, looking at the absolute increase is not enough. So to dive deeper into the reason why it increased, I don't think it's actually due to any asset quality deterioration. So for some banks, it's really a return to normalized levels of provisioning since they were low last year, relatively low last year. For others, it was in response to specific problem segments or some adjustments in their credit risk modeling. So overall, asset quality seems healthy still. Year on year, I think we see an improvement, especially for the banks with higher NPL ratios before. They certainly have improved.
I see.
Yeah.
So it's higher, but it's not worrisome. And I think one of the measures that you would have maybe would be the NPL cover.
Yeah.
Like, what kind of coverage ratios are we seeing right now as far as provisions are concerned?
I think overall the NPL coverage, if I remember, is around 100%. So of course, if you look into the specifics per loan segment, it really differs for secured versus unsecured loans. But then I think I would say that 100% as a whole seems pretty healthy, and it's certainly enough to cover the potential losses.
Yeah, so in case these non-performing loans don't pay off, they have more than enough provisions
to cover,
and we won't see significant losses booked by the banks. Okay. So let's move forward. So one of the things that, for example, we talk about a lot in the show is, you know, inflation going down. The BSP has been telegraphing plans to cut rates. So for this year, I think the expectation is another 50 basis point cut by the BSP. So how will this impact banks' net interest margins and profitability for the rest of the year?
Well, I think maybe we discussed it partly a while ago in our discussion on NIM. But despite the rate cuts that are heading our way, I think that NIM will be fairly stable to maybe at most slightly down. Of course, the big banks or those with relatively higher CASA ratios, maybe they would face more pressure on their funding costs due to the rate cuts, while the smaller banks such as East West, this would actually help them more. But then as a sector, I think NIM should be fairly steady because there's the RRR cut, which for the banks that would see funding cost pressure, the RRR cut would alleviate some of it. In addition to that, there's other balance sheet dynamics that the banks can play into that will help them manage their net interest margin.
I see. So now I'd like to ask you about certain banks. So, for example, I think Security Bank recently made it to the headlines because its capital adequacy ratio was raised as not being high enough or being worrisome. Plus, of course, the acquisition of home credit. So I'd like to get your views about it. I mean, and also Security Bank has been one of the underperforming banks. I mean, do you think it's warranted for it to perform the way it has?
I guess the first thing I would say is that even if they have declined a relatively significant amount over the past 1 year or over the past 2 years, perhaps, they're still above the minimum requirement. So they're still safe. It's just that I think the concerns maybe come from a place of because if they have to manage their capital ratio, it might constrain their asset growth. So that's where personally my concern comes from, especially since they set previously they set a target of double-digit ROE this year. So news that the capital constraints might limit their growth. Plus, recently they also saw an uptick in delinquencies in specific credit card accounts. So I guess that really maybe spiked the fear in some investors, and that could have led to the
poor performance. So now I'd like to ask you about two banks that really have been underperforming the other banks. We have Security Bank and Union Bank. So let's start with Security Bank. I think one of the concerns is its capital adequacy. I think that was sold off because of that. And, some people have been highlighting home credit as, I don't know, maybe they feel like it was bought at an expensive price. So do you think that the sell-off is a bit overdone for Security Bank?
So I guess first off for Security Bank regarding its capital adequacy, despite the decline recently in their capital ratios, I think it's important to establish first that it's still safely above the minimum capital requirement of the central bank. So even though it's slightly reduced, I think the impact would be more that it constrains their growth. The home credit acquisition is actually also connected to the capital concerns in that the home credit acquisition, I think it reduced their capital ratios by maybe 100 bips. So it should be, I think the bank's targeting around 12% now, and the minimum is around 9.5. Yeah.
So the buffer is much smaller now.
Yeah. So they would have to be able to balance their capital as well as the growth.
What are your thoughts about home credit? Is it too expensive? Is it a good acquisition, or is it a bad acquisition?
So far, based on what I've looked into home credit, I think that the price seems fair. Maybe it's slightly expensive, but then for a high growth consumer finance company, it seems like an okay price. Yeah. And in terms of its connection to Security Bank, well, of course, Security Bank is one of the banks that's really looking to grow and heavily investing in their growth in the consumer lending space. So I think that the acquisition of the 25% stake in home credit is just part of that. Well, that's my take on the rationale of it. As for what the implications are for Security Bank, well, we already spoke about the impact on the capital of the bank. But then in terms of its earnings, since it's a 25% stake, then it would appear in Security Bank's financials as, of course, like share net income of home credit. Given that home credit is profitable, we do expect it to be earnings accretive. And it could be meaningful as well in the future
If it grows faster.
if it grows faster. Yeah.
And I think also the business of home credit is synergistic because it's not the same as what Security Bank has right now as far as consumer lending is concerned.
Yeah.
So yeah, it could be another avenue talaga for growth as far as they're concerned. Okay, so another bank that has been underperforming is Union Bank, and I've also noticed that that's one of the banks that you actually don't have a buy rating on. So why is that? Why has Union Bank been underperforming?
So for Union Bank, I think that their story so far has been, I guess, a series of earnings disappointments. Maybe one for the past few years that I've been covering Union
And even
Bank.
during the first quarter, it continued to disappoint, right?
Yeah, even during the first quarter. For this bank, I think that investors' concerns are mainly around the asset quality. It's already happened a few times where I guess their credit costs or their provisioning is elevated, has had to be increased because of upticks in consumer NPLs. Though I think the bank seems to have resolved their problem somewhat. They do, like this year, provisions were high in the first quarter, but then the bank's management did share that they expect it to be trending down. Overall, I think the outlook for this bank seems to be a little bit murky, and I think that sentiment is holding investors back from buying into it.
Okay, so that said, I mean, for the first quarter earnings season, after seeing everything that you've seen, and of course, given the outlook for interest rates going forward, like what would be your favorite banks? Because if I'm an investor and I look at COL's investment guide, you have a buy rating on everything except for Union Bank.
And China Bank.
Oh yeah, and China Bank. So maybe you can tell us what are your favorite banks right now?
I think so far my preference at the moment would be more in the smaller banks. So East West maybe and PNB. I like East West because though it's a small bank, but it's delivering almost double-digit ROE, and it's still really cheap, like 0.3 times. It's trading 0.3 times book right now, while it gives 6% in dividends every year.
That's East West Bank.
Yeah, that's East West Bank. Plus, I think we have a positive outlook on their profits going forward because as a consumer-focused bank, they benefit both from the rate cuts and from the RRR cuts. So, especially with the strong momentum in consumer loan growth, it seems like they're a bank that's well-positioned right now. For PNB, I think that it's also cheap for the return that it's delivering. In addition to that, it seems to be a bank that's, I guess, on the path to recovery. One positive that I really liked about PNB in this earnings season was that they were able to deliver, I think, 7.5% loan growth. And the reason why it might seem low compared to the other banks.
I was just gonna ask.
Yeah,
7.5 is not.
But it's higher than what they've been able to deliver so far. So I think that maybe they're trending in a
Parang may re-rating.
better. Yeah.
Probably a re-rating. And what kind of multiples are they trading at right now?
For PNB, I think it's also maybe 0.35 or somewhere around.
Very cheap.
Somewhere.
Yeah.
And they deliver, and they did distribute they did distribute cash dividends recently. It was a special cash dividend, but then if you look at
what kind of yield is that?
That was around when they announced it, I think it was past 6%. Now maybe 5.8.
Because the stock price went
has
up
yes.
in response to that huge cash dividend.
Yeah. So in terms of going forward into the future, I feel that it specifically has flexibility also to continue with dividend distribution because its capital ratios right now are really high. As I think the highest among all the, if not the, among the highest.
So earlier on, you had mentioned China Bank. Well, you also have a hold rating, but you know, and maybe also, you know, about the big banks. I would think that probably one of the reasons why you don't like them as much is because, you know, they've gone up. So that said, would you change your mind if their share prices go down?
Yeah, I think absolutely. I would look to buy, I guess Metrobank is actually not bad right now, even at this price range. And of course, their dividend yield is very attractive. And it's one of the, I guess, the biggest reasons why we like Metrobank, that it's cheaply priced or cheap in valuation compared to the other two.
Yeah, BDO and BPI.
But BDO and BPI, I like their earnings quality. And as the two biggest banks in the country, I think they're also well positioned to grow as the Philippine economy grows. And even if people expect them to falter, or for example, for margins to deteriorate due to the rate cuts, surprisingly, they're defending their margins well and they're growing their loans well. Their core fee income is also strong. So at more attractive valuations.
Yeah, I think it's more of it's more like the smaller banks probably would have a faster earnings growth compared to the bigger banks, and also because the smaller banks are trading at a cheaper valuation than the bigger banks, no?
Yes.
But everybody is still expected to deliver earnings growth this year. And it's more of a valuation issue. I think even China Bank, the earnings are still expected to grow strongly this year, right?
Yeah.
It's just that it went up so much when it was added to the index. Yeah. So maybe if it just goes down, and then it's an opportunity to buy.
I think around this price, it's trading near our fair value now. So maybe a little bit more.
Yeah, it will be a good opportunity actually.
Yeah.
So at least, you know, still good for the banks. It's more of, you know, let's just wait for prices to go back to more attractive levels to buy them back.
Yeah.
That's it for this episode of the Market Talk series of Intelligent Investing. If you found this discussion useful, don't forget to like and subscribe for more market insights. And remember, stay sharp, stay selective, and as always, invest intelligently.